Finance. Let's turn our attention to the fixed income market, of course, with intensifying fears of the coronavirus wave, not only here in the United States, Brazil, and India, plus a new wave of cases in Beijing that did lead to a partial lockdown, giving us a sense of deja vu of sorts as investors look to find some safety in treasuries, with the yield on the benchmark 10-year sitting at around 0.7%. Kathy Jones, the Chief Fixed Income Strategist at Charles Schwab, joins us now. Thanks for joining us, Kathy.
Thanks for having me.
So, of course, we want to start with the news that the Fed is starting to buy individual corporate bonds. Can you give us a quick reaction here? Is this an expected move? And do we anticipate that this will help buoy the fixed income market?
Well, it is expected. The Fed has indicated since it created this facility that it would, in addition to buying ETFs, that it would buy some individual corporate bonds. I think the interesting wrinkle here, from what I can gather, is that they're going to follow an index strategy and buying individual bonds that meet their criteria. So that's going to be an interesting exercise. I think what they're trying to get away from is the perception that they're favoring one company or one industry over another, so they'll try to spread it out. But again, the bonds have to meet their criteria, which means they're not buying the lowest credit quality bonds in the high yield market. They're going to be buying those with higher credit ratings and up to a 5-year maturity.
I'm just thinking about the Fed's overall strategy. And of course, we heard from Chair Powell last Wednesday about just pure accommodative policy, right? They're going to do everything. They say their toolkit is sort of limitless. Has that been an encouraging sign for you, just seeing this sort of unprecedented remark?
Well, it obviously puts a floor under the market and under risk assets in particular, even in the bond market. So what it tells us is that it puts a lid on how high treasury yields can go, and it puts a floor on how low prices for other sorts of bonds can go. So it keeps those spreads sort of compressed, perhaps more compressed than they would otherwise be. So it's definitely an encouragement for those who want to buy riskier parts of the market. We're getting a little cautious because it's already moved so far, so fast. When you look at, say, the high yield bond market, at the peak of the panic in March, the spread over treasuries was over 1,000 basis points. It's now into about 500. So it's getting close to the average. And so it's moved very far, very fast. But we continue to see that Fed sort of backstop for the market being supported.
And then speaking of that 10-year initially, we haven't seen a 1% handle since, I think, March 19th. When do you really expect yields to rise back above that 1% benchmark? Do you have a target that you're looking at even for the end of 2020?
Yeah, perhaps by the end of 2020. A lot depends on how the economy rebounds, and a lot of that depends on the progress of the virus and getting it under control. We do think that a steepening yield curve with long-term rates edging higher is the most logical outcome of this environment. It's happened in other periods of quantitative easing and in periods of recovery in terms of the economy. So it makes sense. We think 1% maybe by the end of the year. But again, you can't go too high if the Fed is trying very hard to keep rates low overall. So I think 1% is the upper end probably for the second half of the year.
Give us a sense of what you're hearing from your clients. Is there panic? Is there a lot of anxiety, or does their risk appetite seem to have grown, right, as they see people being able to benefit by trading equities during this time, if they're, day trading properly, of course?
Well, I think, as always, there's the range of reactions to this amongst various individual investors. I think one of the interesting things about this particular period, though, is there seemed to be less panic and more people looking for opportunity than perhaps compared to the great financial crisis. So I can remember during the financial crisis, most of the questions I got were sort of panicky, what should I sell? What can I get out of? Where is it safe? This time around, a lot of the calls were sort of, what's the opportunity here? Where should I buy? And I think that is the result of the Fed having been so active so early in the market, providing that backstop and that reassurance to the individual investor. They learned from the financial crisis that when the Fed steps in, that's usually a signal to buy. And I think this time around, that's exactly what we saw happen.
Yeah, it's almost like a proactive parent that's sort of allowing this space for the kids to dabble in the market. Thank you so much, Kathy Jones, for joining us today.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.